Hey everyone, it's time for another episode of Mayhem in the Markets, coming to you Saturday, July 8th, 2023. Brought to you by TraderAid and Macrovisor. On this chart, we can see assets of the Federal Reserve. We're looking at total in blue, total securities held outright in green, and liquidity facilities in red. That spike up in liquidity facilities that we can see earlier this year was from the Fed's reaction to the Silicon Valley banking crisis. But net, Fed supplied liquidity to the market is being pulled back as quantitative tightening continues. And it is likely that this will be important to monitor as we go on, because it is one of the factors that had supported multiple expansion and upward repricing of risk, and it may be a factor that also acts as a weight, or as gravity going the other way. And liquidity is important. When we look at it versus the broader S&P 500, we can see there is a pretty big divergence here. Now, when that begins to matter is a good question. We're in a pretty seasonally strong time of year here, so I don't know that it's going to happen in the very near term. But it is something that we're watching closely, and it's a theme that I think has been important for quite some time. This chart tracks back to the beginning of COVID, but we can track this factor back, going all the way back at least 14 years on and off. It's been pretty well positively correlated. And cyclicals have been outperforming defensives by quite a lot. This has been a theme since the re-risking that we saw in mid-April, after the reaction to the regional banking crisis pushed more capital into defensives. But now we're back at a high that might suggest that there's a little bit of room for this to rebalance. And gross leverage by hedge funds in the broader market has reached a 5-year high of 265.2%. This is a pretty significant number. And I know folks want to pay attention to net, and it's important to look at net as well. That shows more sentiment, though, because when we look at the risk from aggregate positioning, both sides of the book can go against a hedge fund. For more details on all the charts in this presentation, check out the latest charts of the week at Macrovisor, where there's these charts and many more. And if you'd like to get 20% off Macrovisor, you can do so clicking on the link in the description of this video. On me, Bank of Japan's purchase of Japanese government bonds the past 12 months has been almost a quarter of Japan's GDP. The central bank owns about 55% of the country's debt. It's pretty incredible if you think about just how much of an influence the Bank of Japan has had, not just in the country, but also in the broader global equity markets. It's been a provider of liquidity that equities have been ever more reliant on as the Fed's been pulling back. And when we look at the effect that that has had on Japan more directly, the Bank of Japan owns 60% of Japanese ETFs. And we can see the Chinese National Bureau of Statistics, PMIs, manufacturing in contraction, recovering tepidly, and services slowing down, rolling over from some stronger growth. The great reopening that wasn't is what we've been calling it. And the reason is that there was a lot of hope tied to this, but with real estate and construction still not recovering, with a lot of bad debt in both sectors and projects idled, it doesn't seem like we have the internal catalysts, and externally, we don't have the driver for exports from Europe and the United States as their economies are slowing. The second worst half for IPO volume since the great financial crisis. This is a pretty interesting chart. It certainly suggests that we are seeing deal flows, we're seeing IPOs, we're seeing all kinds of different activities slow, really across the board here. And this is where it gets interesting, because it's also in venture capital, right? So you have less fundraising for startups. That means there's less companies that are going to be growing to the point that will become IPOs later as well. And we have the lowest strategic petroleum reserve level since 1983. Strategic petroleum reserve has been utilized to try to combat inflationary pressure at the top line level. And it's been a really effective way to try to add supply into a rather tight market. And that's loosened conditions enough that gasoline prices could come down. And as a result, top line inflation's had some downward pressure. But the question is at what cost? Because the broader concern is that if there is any disruption to an otherwise tight supply market, without a strategic supply of light sweet crude that we can easily refine here into gasoline, we may be in a spot of trouble. Now, people like to say, well, the Sauds can do this and that, but the problem is the Sauds sour crude, Russia's sour crude, Venezuela, if we could ever get them producing again at scale of sour crude as well. So there is some potential if there's a disruption in supply that we could definitely see a change in the dynamics around the price of oil. And I want to thank everyone for tuning into this video. This was brought to you again by MacroVisor and TraderAid. You can get 20% off either one. With TraderAid, you can use the code Mayhem20, and you get 20% off MacroVisor using the link in the description. Supporting my work helps me to keep all this content going, both free and paid content. You can follow me on Twitter at Mayhem4Markets. That's Mayhem number 4 Markets. And be sure to like, subscribe, and share. Videos posted here will be shorter form now. I've been looking at my statistics and looking at the way YouTube has optimized their algorithm, and it's really going to be for videos that are 10 minutes or less. So I hope that's good for everyone out there. Certainly for the folks that are looking for things to be a little bit faster, that's what it's going to be like. It's going to be a little bit more rapidly explained with the longer form content posted at MacroVisor for the more long-term economic views and trading opportunities, trends, and themes, and for TraderAid with the short and intermediate term, technically focused trading. So hope to see you there, but keep coming back for more YouTube content. Check out the Twitter for some of the short form thoughts I have, and really appreciate your views, your likes, and your subscriptions. Thank you.